Let's focus on one of those indicators that can help us determine if we're in a trending or a consolidating market. That's called the Bollinger Band Squeeze. We're going to recap the components of the squeeze, describe the rationale behind the indicator, and present an approach you can use to develop a customized squeeze trading indicator. And after hearing this, maybe consider adding this indicator to help keep you from trading in choppy markets. Now, the components of the squeeze. Number one, Bollinger Bands. The bands is a trading indicator and are the first component, and they measure the movement of closing prices around a moving average. The standard deviation of this movement is calculated, and lines are plotted a fixed number of standard deviations above and below the moving average. This is a very popular indicator and can be used in both breakout and fading strategies. And at its core, the Bollinger Band indicator measures the volatility of closing prices. The bands expand as volatility increases and it contracts as it decreases. And typically the bands are drawn to standard deviations around the moving average, which means that statistically 95% of the closing prices are contained within the band. The second one, Keltner channels. These are the second component, and they're similar to Bollinger Bands in their appearance and their usage. The average true range, the ATR, of price bars is calculated, and the channel lines are drawn a fixed number of ATRs above and below a moving average of closing prices. Now, because the ATR tends to remain fairly consistent, the Keltner channel does not change much in size. And similar to Bollinger Bands, the Keltner channels can be used in both breakouts and fading strategies. Now, typically, the channel lines are drawn 1.5 ATRs above and below the moving average, and the normal interpretation is that price is overbought or oversold as it approaches these lines. An advantage of the Keltner channel over the bands is that it reacts more quickly to price changes, and as trends develop, the channels begin sloping up or down with very little lag. Whenever market volatility decreases, we see the Bollinger Bands tighten, while the Keltner channel remains relatively constant. As volatility continues to decrease, the bands will eventually move inside of the channel lines. This means that using the typical default values, 95% of the closing prices fall within 1.5 ATRs of the moving average. That is what constitutes a squeeze. Here we see an hourly chart of the USD CHF. The Bollinger Bands are the solid lines, the Keltner channel the dotted lines. The rectangles highlight the areas where the bands are contained inside the channel. Now note that during these periods, price chops around in a narrow range until a breakout movement eventually ends the squeeze. If you're a day trader presented with this information, you may decide to sit on the sidelines until the squeeze is over and you are no longer in a choppy market. Now, the squeeze can be applied to any instrument and any time frame. Using the default values for the indicators, 2 standard deviations, a 1.5 ATR, and a 20-period moving average, we can get the results that we just saw in the chart. You can experiment with these values to suit your own views of what constitutes choppy periods, but the defaults are always a great place to start. Now, the squeeze is not the holy grail. It has 2 limitations. The first and more serious limitation is that it's lagging. It will only tell you that you're in a squeeze after the consolidation's already started, and it will tell you that squeeze is over only after the breakout move has already taken place. The second limitation is that the squeeze is not a directional indicator. When the squeeze is over, it doesn't tell you in which direction price is going to move. You'll have to determine that from the price action itself or by combining the squeeze with other directional indicators. This is not much of an issue if you're trading manually, but it does have an impact if you develop an automated strategy. Again, let's be serious. There is no such thing as a holy grail of trading. And although it's simple in concept, it can get a bit confusing staring at all these bands and channels on the chart, especially if you have other indicators plotted on your chart. To help reduce the clutter, you could develop a separate indicator for the squeeze and simply remove the Bollinger Bands and the Keltner channel from the chart. Both indicators are symmetrical, meaning that the upper and lower bands or the channel lines are the same distance from the moving average. That means that we can focus on only one side in developing our indicator. In our case, we'll just consider the upper lines. Then the basic formulas we need are presented here. Or if we translate this into code, we get this. The squeeze is calculated by taking the difference between these 2 values, which simplifies right down to this. Standard deviation, the STD, DEV, and the ATR are basic functions included in all major charting applications. The names are going to vary by your platform, but just dig around a little bit. Well, the BB devs, the number of standard deviations, KC devs, the number of ATRs, and period, the length of the moving average, are your input values. Whenever the Bollinger Bands are outside the Keltner Channel, the squeeze indicator will give you a positive value. Whenever they are inside the Keltner Channel, the squeeze will give you a negative value. Here is our original USD CHF chart with the squeeze indicator added. I've highlighted the areas where the squeeze goes negative. Notice how they coincide with the Bollinger Bands moving inside the Keltner on the price chart. You may also consider displaying the squeeze in a histogram instead of a line, which you may find it easier to read, which you can see here. And as we talked about earlier, the squeeze indicator is not a holy grail. It is instead one more tool for your trading arsenal to help you stay out of choppy trading periods. Use it as a filter in conjunction with other indicators, or use it as one of several setup indicators. You can apply it directly to the chart that you're trading, but personally, we found it to be extremely effective when applied to a higher time frame chart. For example, if you're day trading on a 5-minute chart, apply the squeeze to an hourly or a 4-hour chart and use that as your chop indicator. You will miss out on some winning trades, but consolidation on higher time frames typically yields very choppy trading on the lower time frame. I also encourage you to develop your own custom squeeze indicator for your platform. It does make it easier for you to identify the squeeze, and it's going to clean up your main chart. Plus, once you develop the code, you can build on it, maybe reformulate it as an oscillator, or build on it to develop a simple trading system that will be uniquely your own. Now, trading in choppy markets can be hazardous to your trading account. The faster you can determine the state, the faster you can sit on your hands and preserve your trading capital. And here is our free gift to you. You can download the NP Squeeze indicator right here.